That should be ample time for everybody to get up to speed and log on. So got a great number of participants, so we'll get at it. I've given a number of presentations before, and some of you may already know me, some don't. So I'll just give you a quick overview of my background and of our company, and then go from there. So again, my name is Ed Frezza. I graduated back in '89 with an MBA, and I got into real estate straight into investment grade real estate, meaning I worked for a pension fund. And typically, we're giving our money to these pension funds. They have to invest it wisely and give it back to us at some point when we retire. Typically, they put that money into stocks and bonds, but about 5 or 10% goes into real estate. And so the company that I worked for basically took that 5 or 10%, which was just shy of $1 billion, and they would buy properties like shopping malls and office buildings and sites. And it was my job to analyze this. So from the get-go, I got a really good idea of what makes a good deal. How do the big boys, these pension funds and large companies evaluate deals, what makes sense? But as fate would have it, with the Great Recession we had there, the worst economic performance that Canada had since the Great Depression in the 30s, I found myself with the whole department unemployed. Luckily, I had my real estate license and I gave it a go and I never looked back. So I am a commercial real estate broker. But along the way in 2003, I decided that even though I enjoyed working with clients and helping them find suitable properties, buying and selling commercial properties, I found out that I really enjoyed owning it even more so, finding deals and adding value to my own project. So in 2003, I started with my own portfolio and I grew it to a number of multi-res properties. So all to say that I come to you with actual experience of owning, managing, building these properties, and it's not just theoreticals that I'm talking from. Along the way, I also decided to give back, and that's how I started teaching. And in 2008, I approached TDSB, the Toronto District School Board, and I offered to teach real estate courses, which went well until about 3, 4 years ago with COVID. And with the declining market, there was essentially zero interest. So they contacted me last summer and asked me what I thought might have interest, and missing middle came to mind. There's a lot of interest. Doug Ford introduced Bill 23 in 2023. So this whole missing middle is quite young, and there's a lot of interest, partly because of its newness and partly because of the fact that other avenues for real estate investing have pretty much closed down, meaning if you were a custom home builder, that market has dried up. I don't want to say it's dead, but it's significantly dried up and it's tough to make a living on that. What about pre-construction condos and investing in those? Well, we see where the condo market is. Flipping homes, that too is dried up. So some are interested because it's a new thing. Others are trying to reinvent themselves. And so we started teaching last September, December, and this now is our second semester. We're hosting not just courses through the TDSB, but also through our company Tessa, and we're holding our own in-house courses. If you have any interest in taking one of these courses, at the end of the presentation, I will share you my contact information. Feel free to drop me a line, and happy to give you more information on that. In terms of Tessa, we have 4 components to the company, and I think this is of note for the simple reason that we're able to bring various elements of the entire development process to the forefront. And so we have access in the real estate brokerage side, identifying suitable sites and the feasibility. On the development side, finding the entitlement, going through the entitlement process, and then the building permit, which leads to the construction. Because missing middle developments have a unique requirement when it comes to non-combustibility of load-bearing walls for fire safety, we have a division called Tessa Skeleton, which basically manufactures LSF, which is light steel framing. I'll get that in a second. And then, of course, last but not least is the capital component. Real estate investing is capital intensive, real estate development even more so. So just to go into more detail in each of these 4 elements. So the brokerage arm, we've been around for about 10 or so years. Basically, our focus is on multifamily in development, identify commercial sites, whereas residential agents are really good at helping home buyers, home sellers identify buildings, homes that meet their needs based on, and the valuations based on, the condition, the location, the bathrooms, etc. When it comes to commercial grade real estate, it's more about the numbers. And it really comes down to what kind of income can the property generate. The more income, the more value. And so our job in identifying suitable undervalued sites is to see what is the hidden value that will allow us to bring that value to the forefront. Tesla development takes the elements of entitlement and the construction to the forefront. And the entitlement basically analyzes what can we build on this site, whereas the building permit stage addresses how are we going to build it. And together, you get the building permits and you lead to construction. So our focus is in specializing planning, design, construction management as it pertains to the development side, and we've done over 100 transactions. Like everybody else, we're pivoting more towards the multifamily, the missing middle, because this is where the promise is for the next, I'd say, next decade. In terms of an insight into the type of developments that we've done, we're currently working on a just over 10,000 square foot custom built home, luxury home in the Thornhill area. We've done multiplexes. We've got garden suites under our belt. Extensions. We've done retail in the past. In this case, I'm showing you a Hasty Market, a cosmetic clinic, office build-out. So here, in this case, I'm showing you 8,000 square foot build-out for a Remax office, a gasoline station, Ultramar. So we have quite the diverse portfolio. But as I say, our focus now, like everybody else, is to work in the missing middle space. So in that regard, what we have on the go right now is a 12-plex with a retail on the main floor, commercial on the main floor. We're also working on a larger project, about 65 purpose-built rental units, an industrial unit as well that's just finishing off. So we've talked about the brokerage side, we've talked about the development side, and now we've got the Tesla skeleton. And this is encompassing a product called LSF, which stands for light steel framing. And then the interesting aspect of it is that it's been around for a long time, and we use it predominantly in the industrial and the commercial side. But where it's making a foray into the multifamily is that picture a single family home. Obviously, the government, the city wants to make sure that we're safe. And so there's certain fire regulations in place as it pertains to single family home construction. But now all of a sudden you start putting tenants and families on top of each other in the form of a purpose-built rental, and you can see how that risk of fire or life safety suddenly increases. And so the requirements are more stringent, and so the load-bearing walls need to be non-combustible. Now that certainly can be solved with pouring concrete or with cinder block construction, expensive. A more cost-effective means is the light steel framing. So think of a 2x4, 2x6, 2x8, 2x10 typical lumber. We can replace that with light steel framing. And in simplest form, it's taking a sheet of metal and curling it, and the curling gives it the strength. Some of the side benefits that were not intended but are nice to have is the fact that unlike wood, steel doesn't mold. It's not subject to termites and things of that nature. So there's a bit of a premium for LSF, but it's more than made up for in the fact that it's a cost-effective replacement to concrete and cinder block, and has these other side benefits. So we have a manufacturing plant here in North York, 404, and Finch Avenue. We have frequent tours that we take prospective clients who are interested in using that in their project. If that is of interest to you, again, at the end of the presentation, I'll share with you my contact information, and you're welcome to contact us. We're happy to give you a quote on your project using a hybrid of LSF and lumber. Obviously, non-weight bearing walls, or load bearing walls, we can use a lumber. to try and keep the cost as low as possible. So just to give you an example of what this LSF looks like, we constructed a small little shed, if you will, to give you context of its size. It's 6 feet high, roughly, I think about 4 feet by 4 feet. And if you look at the far left, sorry, far right, you can see that there's divots. The screws are, the divots show where the screws go. So it's very much like a Lego set. These come unassembled on site, and the workers would basically put it together using these screws. And the divots depresses the screw, if you will, so that when you put a sheet of drywall over it, it's a nice clean finish. This is just an example of LSF at a job site, structural components. This is an example of the LSF roll former. So basically, you take your drawings and it gets put in into the machine via this control panel. There's a series of rollers. So you pass the flat sheet of metal onto the rollers, which each roller sequentially bends it just a little bit more so that by the time it comes at the other end, you've got a fully formed piece. You can see on the left, you've got a roll of the steel, and it just gets fed into the machine, and it just keeps cutting these parts. Each LSF component has pre-cut areas where your plumbing would go through, your electrical would go through. So it's ready in that regard as well. Capital. So this, as I mentioned, is a critical component, and we do specialize in assisting clients with regards to MLI Select, CMHC MLI Select, which is the most lucrative financing there is for takeout for missing middle projects. Because of the fact that the Canadian government backs it, gives you a below market interest rate. The fact that you're able to get up to 50-year amortization significantly improves your cash flow. And the way that you can get that is through one of three ways. The CMHC mortgage will reward us and gives us more favorable terms if we're building buildings that are more desirable than the typical ones that are being built. And how do we define that? Well, it's based on three criteria. Is the building more energy efficient? Is the building more bringing more affordable units than normally would? And is the building more accessible, more accessibility friendly than it normally would under normal building codes? So if you do all three or parts thereof and you reach up to 100 points, you can get up to 50-year amortization. So we guide clients through that aspect. So now that you know a little bit about myself and a little bit about the company that I'm with, let's take a look at this particular property. Now, the featured property is a 16-plex, and as of right. Now, this is interesting because this 16-plex sits on a lot 50 by 120, which just a few years ago would have been unthinkable. And the whole idea is that many are going to 4+1. Well, Doug Ford with Bill 23 basically enacted a law that said any single family home in Ontario can now become a triplex. In Toronto, that got upgraded to a fourplex. But on the other hand, you've got CMHC, a federal body that says we want more housing and we will give you this MLI Select lucrative financing. But for that to happen, for you to be able to take advantage of that, it has to have 5 units. And yet the city of Toronto is saying, well, 4 units. Well, how do you make up the difference? And this is where we're seeing 4+1s, adding a accessory dwelling unit in the form of either a laneway or a garden suite to make the 5th unit, which now makes it applicable for the CMHC financing. So the sweet spot is between 4+1 and 10 units. Why 10 units? Well, at the 11th unit, you have to go through what's called site plan approval, a lengthy process, a costly process you want to avoid. So sticking at the 4+1 to 10 is a low-lying fruit in terms of quickness. And the key to success in this business is speed to completion. The longer you wait, holding expensive money and carrying costs, the less profitable the project becomes. So this featured property is of interest because it brings a 16-plex, not just a 4 or 5-plex, a 16-plex to a site. So let's take a closer look. To start off, the property is located in Toronto. what makes it interesting is the fact that it's on a major street. And the significance of that is that in 2023, the city passed something called EHON, EHON, which stands for Expanding Housing Options in Neighborhoods. A mouthful, but basically it says, how do we intensify neighborhoods so that we don't just have single family homes, which back in the 50s, 60s, 70s could be built on large lots because land was cheap. We're now trying to accommodate more people on less land. We had the 60s, 70s expansion experiment where we had suburbanization. Everybody ran out to the suburbs. Well, that didn't work because, quite frankly, the government's broke and can't afford to go and put more postal offices each time a developer puts a new tract of 50, 100, 200 homes. We can't build another school. We can't build another hospital. So in the 90s, we decided, well, let's address the fact that homes are taking too much land and we go the condo route. Well, we see the evils of that in the sense that we have these condos which meet a need on one hand, but have created problems with the other, meaning you have a condo tower with 300, 500 people. We have tremendous gridlock. You have buildings where if you buy a unit in the building, your kids can't go to their local school. So there's some poor planning, and that is not making much sense. So hence this gentle gentrification and trying to find lots within neighborhoods. And so if you can find a lot in a neighborhood on a major thoroughfare that will allow you to go up to 6 stories, and if it's walkable to a major transit station area, the benefit there is that you don't need as much parking as you would if you were further away. So a major transit station area, something like a GO Transit station, a subway station, an LRT station, anything that allows easy, accessible transportation will allow tenants to opt out of owning a vehicle. And especially among the younger generation, it's kind of cool not to have a car and just Uber it wherever you have to go. So the city recognizes this and is allowing for buildings along these major avenues not to require as much stringent parking requirements. In terms of the property details, again, it's a 50 by 120 lot size. The current property was built in 1926, so well past its economic usefulness. In terms of waters and sewers, it's in Toronto, so obviously it's got the municipal serviced uh, waters and sewers, but obviously it's going to need to be upgraded if we're going to put a 16-unit apartment building on it. Um, Importance is the fact that it's a flat parcel of land, relatively flat, so that deals with potential drainage issues we might have. Um, the property is designated as a neighborhoods area, so that's good. So the city wants to see more residential in the area. It's not mired in any kind of secondary plan, which may have given us further restrictions. Zoning bylaw number is 569-2013 that applies, and it's designated as RD. RD is residential um, detached, and about 70% of Toronto, as the city planners have dubbed it, the yellow belt. About 70% of Toronto is this RD and other suitable sites that can accommodate this missing middle. So in this particular case, you see the RD has an F15. The 15 refers to 15 meters, which means that would be the minimum frontage that this property would have. So unlike other neighborhoods where you could actually sever this into two 25-foot lots, this one here would prohibit it, which is why the design went the route of creating one larger building. So this project has been approved. It has received zoning approval as a as a 16-plex, and you can see the renderings. Basically, you would have 4 levels above grade, and that's where you'd have the 16 units, and then you'd have one sub-level basement, which would have a number of amenities. So the development opportunity that was for which there's an approved zoning certificate is this 4-story, 16-unit apartment buildings. It has the following suite mix, and this is kind of interesting. It has a studio and it has a 1 bedroom. Now, CMHC deems affordability based on the household income and then takes and says no more than 30% of that should be applied towards your rent. So if you take that for Toronto, I think the number is around 54,000. You take 30%, you divide it by 12, you get to this magic number of $1,348. That means that if you have at least 10% of your building, 10% of 16 is 1.6 units. Well, you can't have 1.6 units, so you round it up. That means if we had 2 units that we were prepared to rent out for a period of time at 13.48 per month, we will be able to get points on that basis. So it's not necessary that we have to use that, but the design of the floor plate now gives us that option that if we wanted to, we could use that. But as I'll show you, we don't need to because we'll get the points in another way, predominantly through energy efficiency and accessibility. The rest of the units are built out as 6 one-bedrooms and then 8 two-bedrooms. So if you add 8, 6, 1, and 1, you get the 16 units. In terms of the size, the property is about 10,500 square feet, and that's the GFA, basically what's contained within all 5 levels of the building. Interesting note is that there's only 2 parking stalls. And this is what allows us to get more GFA because in the past we had to have a lot more parking, and that minimized the GFA, which minimized your revenue, which minimized the opportunity of developing a profitable building. So this gives us the opportunity to put more GFA if it's properly located and therefore make more deals viable. In lieu of parking, you can see that there are bicycle parking spaces, and this is something that the city is requiring that we put in, and I'll go into more details on that. In terms of the layout, as I mentioned, there are 5 levels, 1 below grade on the lower level there on the left side, and I know this is difficult to read, but I'm going to try and walk you through it. At the front, you've got a driveway with 2 parking, and the parking would have, a requirement for an EV charger. On the right side, you walk down a corridor, which would pass you. I'm not sure if you can see my mouse here, but you'd walk down the corridor towards the back here, upper right, which is a bicycle storage room, bicycle parking. On the left, we've got 13 lockers, and you'll see in our pro formas, we're charging $60 per locker. You've got a mechanical room. You've got the elevator here situated in the middle of the building with the scissor stairs, and then you've got the garbage disposal room, and it's set up so that it's got sections for the organic, for the waste, and for the recyclables. Level 1 is a little different than level 2, 3, and 4. Level 1 is similar to the other levels in that it's got a 2-bedroom at the back and the front on the left side. On the right side, the first level, part of the front is used up by the entrance. So we only have a bachelor at the front and a 1-bedroom at the back. But for levels 2, 3, and 4, we're able to get a 1+1 at the back and a 1+1 at the front. So that gives you an idea of how the layout is for this. So herein is the entitlement hack. The Toronto Municipal Code Chapter 415-45, you can look it up. It's basically a new buildings exemption. It basically says that I know that we've told you all that you need a site plan approval if it's 11 units or more. But in the spirit of trying to make things easier for us to get more units built, we're going to make an exception. And if your site has the following exceptions, you don't need site plan approval and you can in fact bypass it. So what you can do is during the entitlement process is actually get that out of the way at the same time as part and parcel of the entitlement. So by missing that site plan approval, you'll be going straight to the building permit instead of having to go through that extra step. So just to drill down in more detail, the change that we're talking about here is an exemption for specifically small, low-rise, new construction residential buildings, not conversions. You can proceed, if you qualify, without a site plan control approval. It removes one major city approval stream from the critical path, which translates into less time, less money, less reiterative back and forth with the city. Um, and basically, it's designed to streamline the whole process. And again, the goal here is to try and make more of these units possible. The condo market, when it was at full steam, was delivering 25 to 30,000 units. The purpose-built rentals are not there yet. We're trying to ramp up, and so this is where the city realizes that the condo market served a certain segment, but a lot of the units were a lot smaller. And so the hope is that with the purpose-built rentals, we will be building more two-bedroom units and larger units as opposed to a lot of the bachelors and the small one bedrooms that we see typical in the condos that were built. What this does not allow you to do, it doesn't grant you any extra density. So that's not the intent of this. Zoning still governs what you can build as of right. So as of right is basically your permission, what you're permitted to build without seeking any kind of approval from the city. Typically, that's not the way that we would proceed because there's always something on the design stage that says, well, if we just tweak the numbers a little bit and we have a reasonable request deemed to in the form of a minor variance, which is reasonable request, the city should, in theory, let us go with it, but it has big gains to our profitability. And that's why we seek a minor variance. So as of right means we go straight to building permit. Typically, that's not reality. Typically, we need to somehow MacGyver the project so that it optimizes, and that usually means a minor consent, a minor variance in some manner. So that means now, of course, your neighbors know, they have to be consulted, et cetera, et cetera. But it's nowhere near as onerous and as lengthy as a site plan approval. Ontario Building Code still applies, and other approvals may still be required depending on site conditions. So all it does is it minimizes the need or bypasses rather the SPA requirement. So the real benefit to us as developers is less time, less cost, and less risk. Less risk because when you're going into the SPA, it's not a guaranteed thing. You never know what's going to come out of it. And each time you go to the for a site plan application, you're basically giving the city power because now they have say in how this building will look and how it's going to come to fruition. By removing that element, you have less city input, and it gives you more freedom and it gives you a faster track to getting your project completed. So let's look at the numbers. What does this translate into in terms of profitability? So from a hard cost point of view, you will see some people who use, a hard cost of X dollars per square foot, $300, $350 a square foot, and just take the 10,500 square feet GFA and apply the 300 or $325 to get to a number. We broke it down in a lot more detailed fashion here, and without going into the actual details of the amounts, just showing you some of the cost considerations. Now, we can go into this detail because it's already been approved. And once we get to the building stage where we actually have detailed drawings, we can fine tune this even more. So that's how we were able to get to a lot more detailed number than just back the envelope, $325 a square foot for hard costs. Critical point here is to note that CMHC MLI Select, if you get 70 points, it gets you to 45-year amortization. And if you look at item number 4, the elevator with 5 stops, we're getting 30 points for doing that. And then in line item number 6, energy efficiency delta, we're going for the highest tier 3, and getting 50 points. So 50 plus 30 is 80, which exceeds the 70, which therefore right away gets us the 45. Now, I haven't shown you 50, and I believe there's a way that we could actually tweak it to get to 50, but I think if you see the numbers at 45, they're quite impressive on their own. In addition to hard costs, we have soft costs, and whereas hard costs are the materials and labor, the soft costs are all the ancillary services, if you will, professional fees, building permit fees, DCs, development charges, if they're applicable, and we break them down here. So you can see the building permit, architectural, structural, mechanical, electrical, We need electrical drawings because this is more than three stories high. So it's being a part three building means we need the electrical drawings. If it was a part nine, three stories and less, we wouldn't. Permit fees are whatever the city says it is, statutory, same with DCs. Construction financing, we're thinking that 16 months is very doable, probably 14, but we've put a bit of a buffer there, if you will. Financing fees, that's not just the lender fees, but then also the brokerage fees. CMHC premium for takeout. So the premium is an insurance premium based on the loan to cost. So is it 80, 85, 90, 95? As you go up, it gets marginally more expensive. So those are the cost considerations. And again, we can go through that level of detail because we already have the zoning application approved here. Whereas once we get to the building permit stage, we'll be able to fine tune the numbers even more. In terms of looking at the revenue, and again, going back to my comment that commercial properties are heavily weighted based on their ability to generate income. So in this case, on the left-hand side, I've shown you the various unit mixes, and on the far right, the corresponding annual revenue. So here we're showing about $483,000 as gross income. From that, we're going to subtract the vacancy to get the EGI, subtract the expenses to get your net operating income. And the way CMHC operates is to look at the building and apply a DCR, and their magic number is 1.1. So they would discount the net operating income to a lower amount using this DCR of 1.1 to get to a number that they would then apply for the mortgage calculation. So in terms of the project cost, the reason this is important is because CMHC does not lend the takeout, does not give or calculate the takeout based on the final value of the property, but rather on the project cost. So here we're looking at land cost of 1.9. That assumes a land transfer tax and closing. The hard cost, as we had from the previous slide, 3.9 and change. The soft cost of 1.6 and change. And a contingency, which is based as a percentage of the hard cost, to give you a total project cost of 7.7 million. So another question is, well, what is this thing worth and how much money have we made from it? You can see here the calculation of the operating expenses of 103,000. If we go on the previous slide, you can see 103 in red, item number 4. That's where that comes from. So in calculating the numbers, what does it look like afterwards? So at the top, you'll see 10, 15, 20, 25, 30%. The relevance of that is to say, how much money do you have to leave in? How much equity do you have to leave in? And what impact does that have on the loan amount and on the cash flow? So number 5, item number 5, DCR, you can see at 1.11, you're able to get a loan amount of just shy of 7 million. And therefore, you're able to build this property and have takeout with only $773,000 in the project. Having said that, line item number 6 shows that you would, after debt, after all expenses, after all the carrying costs, etc., you're looking at a cash flow of about $3,000 a month. Now you can see that number increases as you leave more money in the deal. In other words, as the mortgage gets smaller. So in the extreme case there, with a 30%, you're actually generating $9,000 a month in positive cash flow from a 16-plex that you own. What's interesting to note here is that going back to the project cost, the other important factor in this whole development is understanding that CMHC requires that the borrower, the developer, have at least a 25% net worth of the project cost. So you would have to demonstrate that you have a net worth of 25% of that number there on the lower right of 7.7 million. That will be one of the caveats, one of the hurdles that you would have to show early on. In terms of the valuation, so we calculated the NOI previously. We take that NOI now and we're going to apply it to a cap rate. And the easiest way to think of a cap rate is for those of you that buy and sell stocks, you've heard of the price income multiplier. Is a stock trading 10 times, 15 times, 20 times? And it's basically a relationship between the income and what it costs. And this is the same kind of idea, it's just in inverse. So you take your NOI, your net income after all expenses, divided by the price, and that gives you the cap rate. Typically, we work the other way around, where we know what the cap rate is because CMHC will tell us what cap rate to use. And until recently, we were using 4%. The reason I'm saying until recently is because as the economy kind of gets weaker, there's a tendency to go to a higher cap rate. And you can see that basically as a response to more conservatism. So at 4%, you can see we've got a valuation of 9.1 million. As that creeps up to four and a quarter, four and a half, you're at 8.6, 8.1 million. So cap rates are tied into interest rates and the general health, if you will, of the economy. And as rates go up, typically cap rates go up. So there's that tie-in. So you can see that with a project cost of roughly 7.7 million, if you executed properly and according to plan, there's that gap, that delta between 7.7 and potentially 9.1 million in value. So there's that potential of 1.4 million in profit at the 4% level, and of course, a little less with the other two. That takes us to the conclusion of the presentation. If anyone has any questions, I would love to take them right now. And we've got about 15 minutes. It's 7:45 by my clock right now. If anyone has any questions, I'm happy to take them right now. I've included in the last page here, you can see the contact information. So again, if you're interested in the courses that are being offered or in the site tours of the LSF or this property or any other investment opportunities, we welcome your call. And this is how you can reach us. Just going through the notes here. Okay, so the questions I have here, do we need to upgrade the existing municipal utilities to accommodate the number of units? Uh, Yes, services will be required to be upgraded, and that's usually done at the very early stage, even before you close on the property. You're trying to assess the site for accessibility. Trees can be a pain, so you want to get an arborist in there. And of course, you want to make sure that there is the possibility for expanding the sewer and the water. If you're in the 416, that's probably not going to be an issue. It's more of an issue if you start moving up to smaller areas, and definitely if you're moving up to the rural areas. Um, How did you get an RD lot rezoned for a 16-unit building? Wasn't there pushback from the neighborhood? Again, looking at the Chapter 415 exemption is how we were able, or how you're able to go and circumvent the SPA. Otherwise, of course, going through the SPA would have caused that problem. So this way, there isn't any kind of um, SPA requirement or neighborhood call on it. Um, the other question we have here is how do you provide parking for units? So on the sidewalk, if you're looking at the building or on the ground level, I guess, actual basement level, you'd have a two-car garage door that would, once it opens, there would be two-car parking. So there would be one for visitor and one that could be used for one of the tenants. And admittedly, that's obviously not going to satisfy everybody that would want a parking. But if your property again is close enough to a major transit station, then you are going to be able to bypass the city's requirement for parking requirements and be able to satisfy it that way. Next question I have here. Any completed projects so far in Toronto for your students can tour? Yes, we do have that. Actually, we make it as part of the course, and we close off the course, the last class, by a site tour of the LSF facility, but also whatever project we have going that kind of most aptly demonstrates the various aspects of construction, et cetera, that we can make an example of. So again, if that's something that's of interest to you, shoot us a quick email and we'll be happy to fit you in on the next one. What zoning should we focus on when looking for properties? Again, the yellow belt basically covers 70%. Yellow is a distinction made by the City of Toronto planners. Their maps are in yellow that show these areas that would be suitable for these type of developments. So they're relatively easy to find. That's not the challenge. The challenge more is in evaluating them for suitability. Just because you can build something doesn't mean you should, because you don't know the profitability and what issues. And regrettably, that's not something you can do very, very quickly. It requires, as the saying goes, garbage in, garbage out. So if you want to have good quality numbers and reports, etc., regrettably, it does cost some money. Next question I have here is, um, are the city inspectors, counselors okay with this in a large detached home neighborhood? Um, that is, yes, a good question, because we've had so much NIMBYism and so much pushback. And so what's happening is that the natural knee-jerk reaction is to think that you were going to have that issue with all these multiplexes. So if you're doing as of right, your neighbors have no say. You basically go straight to building permit and that's it. If you go to a minor variance, like I alluded to earlier, this is where now it becomes in front of um, your neighbors. They had a chance. Now they can't say, no, I don't want that apartment building being built, but they can push back on saying, well, you're going to be building to 4 stories and my tomato plants are not going to get suitable sunlight. And so we have to, skew the design of the building so that, it doesn't minimize sunlight or something of that nature. So that would be a shadow study that would be required. So you open yourself to that kind of stuff. But with 415, chapter 415, you're bypassing that. Um, Next question I have here is, what's the forced equity from the initial purchase of the lot to getting it shovel ready? So, as has been noted, 25 to 30% of the total project cost. So if you recall, in this example, we had a 7.7 million. So 30%, about $2 million. So that's what you would need upfront. But as we showed you in the best case scenario, you'd only need 10%. You could theoretically leave only 700 grand in the deal and get all the other money paid out to you and still own a brand new building that still cash flows and appreciates. If appreciation in Toronto in the good years was 10% per year, let's say it's use a conservative 5% per year increase on the long term. Well, better to make 5% on a 7, 8 million, $9 million building annually and get cash flow and pay down your mortgage than to leave the property undeveloped as a $2 million property and only make 5% per year on that. So that's a general reasoning why people are looking at this missing middle and redeveloping. Um, Next question I have here. Uh, I think you're looking for clarification of what you pay for the lot versus what the lot is worth once rezoned. So yes, very good question. So one of the benefits of this whole redevelopment is there's not that much money on the construction side. Yes, there's some money, but the real value, the real kick is in the development side. And the development side is where you're taking a property and forcing the appreciation through some sort of lift. And in this case, by adding more density, taking that single family home that until recently you could only build a single family home, and as in this case, bringing it to permit the building of 16 units. So I'm just going to use crazy numbers, but let's say we paid $1 million for it to build a 4+1, and we will get a commercial appraisal that would show us two values. Number one, to say, yeah, the $1 million that you paid was a reasonable number. It made sense. You bought it above, it was above market or below market. It was the right value. So it gives lenders a confidence of what you pay for it makes sense. But then, more importantly, to try and figure out, well, what is this worth if we go through all the entitlement? And they will give you a value, and that is part of your equity requirement. So you don't necessarily need, say, 30% of 7.7 million up from the get-go, because to operate and to make this happen, because you've just created 400 grand through, or whatever the number is, through that land lift, through the entitlement process before you even put a shovel in the ground. The next question I have here is, how much time would you say it takes from the initial CMHC application to the point of getting a building permit? It all depends on how much is required. If you're going straight to building permit, you're probably looking at 4, maybe 6 months in total. The CMHC application, I think it needs a little clarification here, because there's two ways you can go through CMHC. The CMHC MLI Select allows you to do construction financing as well as takeout. And increasingly, especially at these smaller, 4+1, 6+1 transactions, it's more feasible. It makes more sense from a perspective of speed and efficiency, to go with a private lender. And then once the building is nearing completion, to go to CMHC MLI Select as a takeout. Um, we have a question here, 4% cap rate, that is real. So that is based on a number of appraisals that I've seen on projects end of last year. But as I mentioned, as the economy starts getting a little spooky, and there's uneasiness, or there's potential for interest rates to go up, we see that the markets correspond by increasing the cap rate. So in this case, it might go to 4.25 or 4.5. But the reason we show the 4.25 and 4.5 is to show what sensitivity on the downside you have. If it goes to 3.5 cap rate, that's in our favor. Now the building's worth, instead of 9 million, it's worth 10 or 11 million. We can handle that. What we can't handle is if the building is worth less and less and less. And so the purpose of using the 4.25 and 4.5 is to get a sense of the sensitivity analysis to a change in interest rates and change in the cap rates. DCs on the project. Yes, you'd have DCs on the project because you've got more than 6. In Toronto, all RD, all single family homes can go straight to fourplex. In 9 wards, those wards have made it so that you can now, as of right, go straight to a sixplex. And the city has further indicated that there are no development charges up to 6 units. It was a bit of a pain, because, well, what if you want to build 7plex? You now have to pay fees, development charges on all 7. And that just basically, the government is shooting themselves in the foot, because the whole idea is to build more units. And here they're making it more difficult and suppressing the number of units being built, because it's a deterrent, right? Moving along with the questions here. What is the total square footage of this project you're presenting? 10,500 roughly. Will this slide be shared so we can review numbers again? Yes, we're putting together a recording. We're going to need some time to edit it and put it together, but that should be forthcoming. Again, if you're interested, just reach out to us. Okay, we're getting close to 8 o'clock, and I've got a lot of questions here, so I'm trying to be selective on which ones I can answer. If rent goes down drastically, what happens? So this is where we do sensitivity analysis, not just on the valuation, but also on the rental income. So it's really important, it's prudent that you get a good handle of what market rates are. And in the current environment where rental rates, not just property values, but also rental rates, have a bit of a downward pressure on them. We've seen rents go down by, let's say, 10% for a round number. And consensus is that that number may continue to go down in 2026. The positive thing is that we have essentially stopped condo development, and in the absence of further supply, simple economics 101 says that if you mess up with the supply and you keep getting more demand, eventually you'll have full absorption, and there'll be an upward pressure on prices and rental rates. So the good thing is that even though the rents are a bit softening right now, if you were to start a project like this, you probably are not going to be finished for another, say, 24 months. And by then, general consensus is that in 2 or 3 years' time, we should be out of this mess that we're in right now. And we're back to recovery. Is there a post-construction appraisal available? No, I don't have that available. But that is something obviously we can get. How much do you charge to tell me how many units can be built on the property maximum? So this is where if you came to us with a project and basically said I've got property ABC, and I haven't put an offer on it yet, or maybe I have put an offer and I've tied it up and I've got, say, 30, 60 days, whatever, 30 days for conditional. Part of that, your due diligence would be to get a feasibility. Now, you can do your own, depending on your ability, but we provide a comprehensive analysis. We start off with the entitlement side. What can we build? What's the biggest massing we can build? Then we look at the market rates to the various types of units, 1, 2, 3 bedrooms, and come up with a pro forma and generate the general feasibility, financial feasibility and doability of the project. So that one, in answering your question, we start off at $2,500. It takes about 2 weeks. A turnaround, if you want to tweak it so that you're actually getting a proper utilization, optimization of the site by going for some minor variances, then that is, I believe, 2,600. Don't quote me, but it's in that range. Next question. For single family homes in the 4+1 conversion, what are the challenges? Building was originally made for only one unit. Well, this is the challenge when working with additions or extensions, is you're dealing with an older building and you're trying to make things fit. Um, if you're going to do an extension or a top up, it's one thing, but if you're going to do both, you're not really saving anything. You might as well just start from scratch. So, and you also want to look at the condition of your foundations. Are they in decent shape, or is there leaks, et cetera, et cetera. So, it's tough to answer that question, but I think your challenge is, first and foremost, is number one, you're dealing with old stuff, and now you're trying to move around it. Like if you have old walls, how do you bring the energy efficiency of that wall? You got to take the old plaster off. You might as well just knock it down and start from scratch. Then, of course, how you deal with optimization. Typically, in the past, those single-family homes did not optimize the footprint of the land. So it becomes very challenging very, very quickly. In our estimation, typically it makes more sense just to start from scratch. But that's kind of an overgeneralization statement. How much does this course cost, and how can we get more information on it? Again, contact us. I can give you a quick overview right now that for the TDSB course that I teach, it's now started in January. It's 9 weeks, 9 Saturday mornings, or nine. Um, I got a question here, and I think this will be my last question here, just because it's 8 o'clock and I promised to be finished by 8. The last question I'll take here is, would you not want to do takeout financing with CMHC based on value of the built-out property? Absolutely, you would. But CMHC people won't let you. They won't go loan to value. They're going to go loan to cost. So in this case, the building project was 7.7 million. It's nice for us to know what the value is at 4 cap, 4.25 cap, 4.5 cap, because we want to know how much juice is in the deal and how much equity we're sitting on, even though we won't be able to tap into that equity until A, we sell the building, or B, we refinance after the first, say, 5-year hold. But CMHC has strict guidelines, and for them to offer their backing and their assurance, they will obviously want to protect their behind, and so they use the more conservative number, which is the loan to cost. not loan to value. So I agree. I too would prefer the loan to value, but no, it's the loan to cost. So I've got 8 o'clock right now. I wish I had time to answer all your questions. Again, please do feel free to reach out to us, email or text, and we'll try to get back to you in time. And if you are interested in the recording, we should be able to get that to you in maybe a week or so. Again, thank you very much for your participation and have a wonderful evening.